Hey traders, this is Blake Morrow with Trader Summit, and I have a special interview for you today. We didn't think he was coming, but it's a big deal that you're here, Jim. We have Jim Welsh from Macro Tides. He's joining us. I know you're leaving out of town, and I'm very
Yes.
thankful that you're here to shed some light on the FOMC and this crazy price action we've seen over the course of the less than 24 hours. It's been such a wild ride. But Jim, in your words, really quick before we get into your very short
Yeah.
presentation, tell us what your thoughts are right off the bat regarding the Fed the last 24 hours.
Well, I was surprised that the Fed went 50 instead of 25. At the same time, I thought the Fed would maybe go 200 basis points through the end of next year. That's exactly what they did. Markets were split in terms of whether they'd go 25 or 50. So as soon as the 50 hit the tape, obviously everything had a very strong knee-jerk reaction, and then kind of sold off or pulled back. I think as people say, well, wait a second, they're not going to ease as much as we thought next year. I think the Fed reacted the way it did because of the greater weakness that has shown up in the labor market. You know, that's kind of been the focus point as we've talked. Inflation's been downgraded, labor market the key, the job revision of 800,000, Powell noted the last two labor reports were softer. We talked about that a couple of weeks ago with the revisions and so forth. So I think the Fed is concerned that maybe the labor market is weakening more than was originally thought, which again is something you and I have talked about. And the Fed basically said, you know what? Let's go a little bit more sooner rather than later to provide more cushion to the economy as we get into next year.
Now,
So
he said don't expect this to be the normal pace, right?
right. And again, if you look, and we might as well just jump in right now to that first chart, because what I do, Blake, is I take each member's vote with each of the 19 people on the FOMC, say, well, this is where I think rates are going to be at the end of 24 and 2025. And I just do a spreadsheet where it's like, well, how many people were at 4 3/8? There were two of them, and so forth. And then you come up with the average. And when the average is 4.45, the current Fed funds rate is 5.37, effectively, the mid-range. So in a sense, what this is saying, yeah, the Fed voted, and on balance, they're going to cut the funds rate 93 basis points. The thing I would point out is that if you look at the numbers, you had 9 people that were at 4 5/8 or higher. So, again, what this implies to me is, and we had a dissenting vote for the first time since 2005. So this move to 50, I think was like it got nudged over the finish line and there was enough consensus. That's what they went with. But I think it tells us also that to expect 50 basis points either in November or December is not appropriate given this data. And again, the Fed is data dependent. There's going to be 2 more labor reports that come out before the next meeting on November 7th. That is going to really dictate, I think, more than anything else, just like they dictated what happened yesterday.
Well, Bowman was the dissenter, and
Yeah.
she's a known hawk, but
Yeah.
but at the same time, doesn't the Fed Chair Powell say we have to have a unanimous decision?
He works hard to get it, but at the same time, I think, it's kind of like mutual respect. At some point in time, you're also going to have to respect someone who disagrees with you strongly enough to allow a dissenting vote. And so I think it's a healthy thing, quite honestly, to see a dissenting vote, which shows that they had a lively conversation. And despite everything that was said, one person was so far as to saying, I'm not on board. That also tells us there probably were at least, a couple more, maybe 3 people who were, okay, I'll go along with the consensus. We'll go 50 basis points. And the dot plot to me kind of implies that. And then in 2025, you can see bottom right corner, 200 basis points of cuts. That's a total of 8. which 7 because we had a 50, right? Wall Street was pricing in 250 basis points of cuts by the end of next year. And I think that's why when people, yeah, great, we got the 50. Oh no. And so I did a special report yesterday, update, and I referenced the old Miller Lite beer commercials. Tastes great, less filling. And so that 50
wasn't that one? Just kidding.
There's a lot of it. Started in 1973. I mean, we're at the 50-year mark of those commercials.
Wow.
And I remember them. Oh man. Anyway, my point is, tastes great. Yeah, we got the 50. Less filling. We're only going to get 200. And I think that's why the market reacted the way it did. But make no mistake about it. These are people writing numbers down on a piece of paper. In March of 2022, this PCE was north of 6%. Powell had said inflation wasn't transitory. And in March of 22, just so I reference this correctly, the FOMC numbers thought the funds rate would end 2022 at 1.9. It ended at 4.4. In 2023, they thought it would end at 2.8. It got to 5.4 in July of 23. So my point is, when the economy's at an inflection point, these numbers are really no valuable than the piece of paper that they're written on. And if the economy does indeed slow more, you're going to see more rate cuts than what they just scribbled in yesterday. But the markets have to deal with what was presented yesterday. And, there was happiness for the 50. Second guess was, oh, gee, we're not getting our 250. This morning, or overnight, I should say, I did a tweet yesterday morning, kind of like, okay, what's going to happen here is the Fed's going to, I thought, go 25, not 50, and only did 200. And Wall Street's going to, react negatively. And then there's going to be, well, wait a second, we're not going to have a recession, and the Fed's still going to cut rates. And I think that's the reaction we got overnight in the big gap opening in the S&P and the other indices this morning.
Jim, okay, and look, you've been talking about, recessionary type of data coming our way. It's eventually going to hit, but this is all soft landing stuff. This is what everybody's talking about,
Yep.
and that's why stocks are higher.
Yes.
And I'm a doubter that we're actually going to get a recession. I know this is what you still, or at least you had believed.
Yeah.
But and like a lot of the market, I think a lot of the market takes a step back and says, look, the data is just not bad. Weekly unemployment claims back down to 219,000 today. I mean, this is all soft landing stuff, and we're getting an easier Fed. So what's there not to like? So with that being said, Jim, you got to technically walk us through these markets. I know you got to catch a plane. So let's go through.
Real quick, I just want to address what you just said, Blake, because I don't disagree with it. At the same time, 2 months ago, I was talking about the claims that we were like, if the seasonal pattern that has existed for 2018, 19, and last year, we were going to see claims decline. And it has followed that seasonal pattern. So I'm not willing to say, oh my God, that proves that there's no recession. It's following the seasonal pattern. Again, why did the Fed go 50 instead of 25? Because they're worried about labor market weakness. So if the labor market was truly healthy, they wouldn't have gone 50. So anyway, all right, here's gold. The expectation was that we'd see a rally above 25.29. In this past Monday's weekly technical review, I said, it looks like there's one more pop that should take place. Gold got up to 25.97. It then had a key reversal, higher high, lower low than the prior day, and closed down. And if we look at back on April 12th, there was a key reversal, and May 20th. Both of those were followed by more price weakness. So again, to me, I think potentially that reversal yesterday is an indication that we are going to see a pullback. 2,300, 2,350, I think is possible. Then I think we're going higher. So longer term, still bullish on gold. I just think we've gotten to a place where a pullback is likely to take place. It should, at a minimum, get below 2,400, and then
All
we'll take
right.
it from there.
Well, it definitely showed a reversal yesterday, but it's eaten away at that
Yeah,
today. So, and that's still a
yeah,
lot of
it's
the
trying to
market.
get,
It's been
yes, trying to
very
get back.
neck breaking price action. So let's talk about TLT. How do you feel about this? Because we saw a really big reversal in the bond market. Yields were rallying yesterday pretty aggressively. Is
Right.
that going to continue? Are we going to continue to see a pullback here?
My take is yes, yields are going to work their way higher. I noted last week when we talked that on the 30-year and on TLT, they had made higher price highs, and yet the RSI, that bottom panel, had made lower highs. The same thing had happened last December, which presaged a pullback. I don't think we're going to get the kind of pullback that we saw after the December high, but could TLT get down to 97.60 or maybe something less than that? Yeah. Then again, I think the bigger picture is we're going to see the economy slow more than expected. And next year, I think a recession. What that implies in my mind is, yeah, we get a period of rates going up a little bit, but then I think there's going to be another period of declining Treasury yields and TLT rallying. But near term, as the notes say, subscribers who bought TLT at 91.13 sold a third of the position at 99.93, and the balance was stopped out yesterday at 99.69. So I'm still bullish, but to me, there was enough evidence to say, you know what, it's time to reduce exposure, and let's see, what happens. My guess is we'll see more price weakness in TLT.
Well, for the stock market, you've been looking for a fresh new high. Well, we got that today, brand new all-time high. But the market seems a little hesitant, even though we're breaking out. Are we going to be going to 58, 5,900, 6,000, someplace that you've been talking about for the last couple of weeks?
Yeah. Well, again, we've done the minimum, which was a new high. To me, it looks like it's potentially completing 5 waves up from the low we saw in August and 5 waves up from the low in April when the S&P was, I think, at 49.54. So the wave target was 57.25, 57.43. I think we got very, very close to that, Blake. So to me, again, this is a window of vulnerability based on the price pattern, sentiment being obviously pretty crazy, gap open 90 some points on the S&P. So I think we're setting up for a pullback. The first target would be the low we saw a couple of weeks ago at 5,400-ish, or down closer to 5,100. I'm not overly bearish yet in any way because the advanced decline line made a new high a couple of days ago. New highs have been averaging over about 400 compared to 10 new lows or less. So momentum-wise, Blake, those are all very strong numbers. The pattern suggests, okay, it's time to lighten up. The expectation was we'd see a rally above 56.70. Price targets were just about there. So to me, this is a place to hit the sell button, and let's just wait to see what comes next.
So the last chart you brought is the dollar, and the dollar really we hit a fresh low yesterday following the initial announcement, but we didn't get any follow through, and we popped back up, and today we're just flopping around inside this range. Is this it for the dollar? I mean, people are pretty bearish right now. Can the dollar really give us some further downside below 100?
I think so, but we may get a pop toward the 101.92 or slightly above. In other words, that initial bounce to 101.92, Blake, was wave A of wave 4. A, B, C down to yesterday's intraday low at 100.21. And then you get a wave C to complete wave 4 that gets you up towards the 101.92, maybe a little bit above that. And then I believe you get wave 5 that takes the dollar down below 100. Next year, as I've said numerous times, I think 95 is in the cards. But if we get this decline below 100, That I think will complete all of wave 3. In other words, this thing has been subdividing, and then you're probably going to get another rally before we see another leg down. But near term, I think there's a little bit more upside possible, but I do think the dollar is dropping below 100 before the end of the year.
Well, Jim, I'll tell you, you're going out of town, and we're going to miss you. I believe we will not be together next week because you're taking a whole week off, right?
I'll be back Thursday night.
Oh, okay.
So,
Well, then
so,
we will see you next
that's really
week.
what it came down to, Blake. We weren't going to do our thing tomorrow, and it's like I can't go 2 whole weeks without Blake, man. So thankfully we should be able to do something on next Friday. It'll be kind of a scramble on my end because I think my plane doesn't get in. I won't be getting home until like 11 o'clock next Thursday night, but that's okay. It's always I love doing this stuff. It's great talking to you. You always ask great questions, and I think we're providing some good information to the traders, and that's all we're trying to accomplish.
100%. And remember to get more about what Jim does, go to macrotides.com. Send him an email at jimwelshmacro@gmail. Is that correct?
Yep, you
Okay.
got it. Wow.
And then also, since you are going out of town and things are heating up in the Middle East, it's pretty much you might end up being the catalyst for higher volatility as you leave your desk, Jim. And if so, we're gonna kick you out.
If I can go back the last 35 years, I was out of town for the crash of '87, when Saddam invaded Kuwait in 1990, and a few other I was out of town when October of 2008 happened. I mean, there's a few other instances I won't bore you with, but I think you've had a similar life experience where things happen when we're not there minding the store. So yeah, next week could be kind of crazy.
All right. Well, let's hope so, Jim. Not for anything bad, but let's hope we get some increased volatility. Jim, I want to thank you very much for making time for us. I know it is you're on the way out the door. If you guys appreciate what Jim does, make sure you give him a thumbs up. Subscribe to the channel so you don't miss any of this exclusive content here on Trader Summit. And also comment down below if there's something that you do agree or disagree with what Jim has to say. I'm sure he'll be checking his messages in very limited internet capability out of town.
Yeah. Yeah. The hide the other mental limited capability. That's good. That's right. All right. Thank you, Blake.
Thank you, Jim. Have a great trip. We'll see you next week.
You got it, buddy.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.